strategy session at TradersWay. Today is Monday, January 5th, 2015. My name is Wayne McDonald. I'm your humble currency strategist. Been doing trading currencies every single day for hours and hours and hours and hours and hours and hours and hours every single day for over 10 years. And I'll be your guide through today's session. I have a request for covering euro, pound, yen, Aussie. I have Jim requests that I go over USD CAD. All of it sounds good to me. Let's do it all. Let's get this party started. Now let me remind you that trading currencies, especially with leverage, is extremely risky, not appropriate for everyone. Yeah, I have been trading currencies for 10 years. Great. It's risky for me every day, and it's risky for you, so it's not appropriate for everyone. I recommend you start on a demo account and develop a track record of success before risking real money. So the strategies and techniques that you're going to see today are pretty generic, developed by market participants over 1,000 years of trading. But that doesn't predict future results, so stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Okay? The name of the game is risk, not reward. So be careful out there. Okay, quick overview of the market here. British pound, extremely weak. Euro, extremely weak. Do you guys know why? Were you following the news today? Well, we'll get into the British pound. They missed their news results. All right, so it's coming down like a ton of bricks. So we can go over that. And then Draghi, what, a couple of days ago? What did Draghi say? That risk of deflation is near. Like, really? It's been near for about a year, right? And then what did he say? The possibility of the ECB missing or not achieving their mandate is higher now than 6 months ago. Whoa! So what's the fundamental response by Draghi to that? That they might not be able to achieve the mission of the ECB and they might still be running into deflation? What's the response by the central bank? And of course, more importantly, then what's your response to that response? Anybody? Type in a question mark if you don't know. Probably quantitative easing. Okay, quantitative easing. We already have the negative rates, but thank you. Yeah, probably quantitative easing, and the question is, has it been priced in? How much has been priced in? All that kind of stuff. But generally speaking, that means euro comes down. Okay. So we'll get into that, but euro and pound are very, very weak. And guess what? Swiss franc is weak. So the European currencies, right, are very, very weak right now. Japanese yen, very strong. US dollar, very strong. Aussie dollar, moderately strong. Canadian dollar, very strong. And get this, Kiwi dollar was strong, then it was super weak, and now it's super strong again. Isn't that interesting? So again, British pound, British pound weak, euro weak, Swissy weak, yen strong, dollar strong, Aussie strong, CAD strong, Kiwi strong. Or maybe it's just the euro and the pound are so weak, everything relative to them looks strong. But yeah, very interesting, huh? So that's the big stuff going on right now, fundamentally speaking. Let's go over the commitment of traders report really quickly. Can you guys see this okay? Please let me know. Thank you, Nuno. Thank you, Daniel. Thank you, Ernest. All right. Okay, so what we're looking at here is actually the black line, which is the net. Okay, and you can see the report. There are more people net short euro now than a week ago. And there was a quiet time here from about Thanksgiving to the new year where the market was still short, but sort of net short. You know, it's still net short, but a little less, a little less. No one was really buying, but people were getting out of the short positions, which tells me profit taking. But week over week, there's now more people short than the previous week. So we're net short and now adding to the short positions. Euro's weak. All right. Now these are open positions reported to the CFTC, so they're large positions. Essentially, this is hedge funds. It says non-hedging. Well, most hedge funds don't actually hedge, right? Right? So they're speculative, right? So they're short and they're adding to those positions and they're large positions, right? So those are the big boys. They were short. They did some profit taking into the end of the year and now they're adding to the short positions again. Okay? This is the British pound. And quickly, the gray line, these are people that long positions, long positions in the pound. No change over over the last week or so. Change colors. Okay. The orange line, as you can see, are those that are actually short. So let me do this in a funky kind of blue. Okay. No one, it looks like if you look at this, no one went short, no one went long. So what happened? Very little, statistically speaking. You see the change week over week? Essentially no change in the British pound. Okay? Now this is inflation week. Oops. This is inflation week, so perhaps people were getting ready for the news. And British pound fell hard today, as you know, and ended last week pretty hard. So we'll cover that, how to follow that up technically. And this is CFTC data that's reported on Friday from the previous Tuesday. So it's a little old, but these are big, large, fundamental positions. All right, so it's strategy more than it is tactic. Japanese yen, traders have added to their short positions. And anybody long got out. Now that is interesting, isn't it? Look at week over week, anyone that was long, or let's say many of those that were long have gotten out of those long positions. And therefore, boom. Okay? Now what's interesting though is there's also less people short. So now we just have to convince them to go short. All right? So less people long, less people short. Sounds like a lot of profit taking, people getting out, right? Waiting for the new year. The big question is, do we get the fundamental trend based on Japanese yen weakness to create inflation? That's the goal of the Japanese government and the Bank of Japan. But we also face seasonality with the Japanese yen, don't we? And everyone's kind of waiting. If you remember last year, about the second week of January, the Japanese yen went from super weak to unbelievably strong. And the yen pairs dropped about 500 pips in very short order. So people are kind of standing around like, is it going to happen? Is it going to happen? Repatriation, repatriation. So right now, it looks like people are just simply getting out of the yen trades. Now, what would that do to the Japanese yen? Weaken it or strengthen it? We don't know. No one's really going long and no one's adding to the shorts, but it seems like people are getting out. What does that do? Because we need to know that, right? We need to know that as currency traders, right? Isn't that our job? No, it's not confusion, King. It's clarity. These are large positions. These guys have quants on their team. They have dozens of interns, from Harvard and MIT running around calculating and creating strategies, and they have $1 million computers crunching things in real time coming up. I mean, this is a big deal, right? It's not confusion, it's clarity. And what that does is it creates Japanese yen strength, because going into this, right, the market was net short, right? Very few people were buying the Japanese yen. The market was very, 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 very net short. It's still net short, and it's more short than it was a week ago. However, there's a lot less volume, and that can still create some Japanese yen strength. And again, this might be because of repatriation, which is a seasonality issue with the Japanese yen, and we can talk about that over the next coming days and weeks here at TradersWay.com. I will be here for you. But that's a big deal, and you can see it, and they're adjusting their positions accordingly. Check that out. Wow. Wow. That's that big spike. Remember that in the Euro Swissy? Amazing, huh? Boom. Well, the market's still net short Swissy. The other interesting thing here is, check it out. Okay. Nobody's going long, and everybody's staying short. But there was a lot of profit taking, and then people jumped back in on the pullback. Don't blame them. Aussie. Oi, oi, oi. What's going on here? Falling fast, furiously. Right, we're way down here in price. This should have been a fairly easy trade. When we were at 90, let's go over this, Aussie dollar. Okay, let me grab my pen, change the color, do a nice blue. Okay, when we were at 90, what did Governor Stevens of the Reserve Bank of Australia, what did Governor Stevens at the RBA say that the Aussie dollar was worth versus the USD? What did the guy in charge of the value of the Aussie dollar say it was worth when we were at 90? He said 85. Great. So what happened to the yeah, and you know what? Actually, last year we were at 97, and he said it was worth 85. So it dropped all the way to what? 85. Well, King says overvalued. No, he gave specific numbers. This should just be like fish jumping into the canoe. Right? All right, so now we get into 85. All right, so it dropped from 97 to 85, then went from 85 back to 90, and then what did it got to 90? He said it was worth 75. Whoa! So guess what? We came down to the 85 again. It was a big double bottom. We hesitated there a long time, then we broke through, and now we're at 80. So according to Governor Stevens, the head of the Reserve Bank of Australia, there's 500 pips more to be made on the Aussie versus the US dollar. And you knew this, in fact, what, a month ago? 6 weeks ago, maybe? I mean, I don't know if you just, I'm not saying, like, it's not my opinion. It's not my analysis. It's not my deep alpha, you know. This is what the guy in charge says it's worth. Right? It's almost like a merger arbitrage play. Soon as it's announced that a company is going to acquire another one and pay a premium to take over its stock, and the premium is 30%, guess what? The value of that company goes up by 30% in about 1 minute. Because there's arbitrage. Whatever. Event-driven strategies, right? But anyways, so, you know, it's falling steadily. It's coming down, down. So, you know, if you had a strategy in place, you'd be selling rallies. You would actually type it down on your MT4 chart, sell rally. And I do that. Oh, that's great, eh? All right, Kiwi, neutral. Look at neutral, as neutral can be. Look at that. Like, no change, no nothing, Nothing's going on. Be careful. But that's what you want in a carry trade. Okay, first of all, Kiwi has a good yield. Nice, safe currency to be grabbing a yield on. You know, compared to like, I don't know, South African Rand, Turkish Lira, Mexican Peso, that kind of thing. A little more, you know, quite a bit more risk built into those. Kiwi, okay, a lot less risk. Okay, so you'd want to be long that. It's not a good economy to be long. I'm just saying based on yield differential, right? You find something that is very cheap to borrow, and then you put it into something that gives you a guaranteed return. All right, that's just a yield differential play, otherwise known as a carry. And what you want now is to borrow money from that's cheap. Let's say like Japanese yen or U.S. dollar, right, or Swiss franc. The second thing is you want Kiwi to go up because you don't want to lose money on the pips, and you want the currency that you borrowed. Again, let's say your cheap ones would be dollar, yen, Swissy, and some others, and euro, right? But you also want those ideally to go down or really to move sideways, right? So on your Kiwi, you want to, let's say, be long Kiwi versus maybe euro, because euro is cheap and it's likely to lose value. Okay, so that could be a good carry trade. But you know what? It's probably going to move more on the euro than on the carry, and that can create some choppy situations and some scary situations, and you'll be sweating bullets, right? So it's actually, it might be a good trade, but it might not be a good carry trade. So another choice if you're long Kiwi would be yen. But again, when that moves, it's probably going to be the Japanese yen moving more than anything, right? When the yen's weak, it's going to go up. When the yen's strong, it's going to come down. And all right, so again, you got the right yield differential, but you're going to get a lot of built-in volatility based on these. So maybe if the yen's repatriate and come down several hundred pips, maybe you can go long, jam a stop, and let it run. Use a binary option to hedge it if you can, right? Dollar, is dollar going to be weak? No, I don't think so. So I wouldn't want to be long Kiwi, short US dollar. That just fundamentally doesn't make sense to me. So the last one would be like, how about, Kiwi Swiss franc? Right? Is Kiwi Swiss franc? Well, let's put it this way. Is the Swiss franc likely to get super strong? Probably not, because we're at the 120 level set by the Swiss National Bank. So there's very little downside based on what the Swiss National Bank has told us, but there's a potential for severe Swiss franc weakness, but not necessarily. So we're hovering in a very stable way for the Swiss franc, and then Kiwi just chugging along. And that's what you want. You want your carry trades really first of all, in this case, you want it to go up. But you don't want it to go up too fast. You do not want it to go up in this situation where the pips are worth more than the yield, because all of a sudden you start sweating bullets on when you should take profit, talk yourself out of a really good trade. A carry trade should be based on getting paid every single day of the week, no matter what, with your stop at break even so that there's no way you can lose. So really, you don't want the volatility. You see what I mean? It's not a volatility play. If you make too many pips on the upside, then the pips are worth more than the carry, and you get yourself out of a good trade. Or the pullbacks, you end up losing 50% of your profit, so you bail there, and it's not good. You just want one that just kind of slowly goes up, and there's no reason to get out. There's no, for profit, there's no reason to get out for loss because you're profitable, and that's what it's a sleeper. But at the end of the year, you've made, because of leverage and stuff, you've made 100, 200, 300% return on investment on a trade that basically went nowhere and just stops at break even. Hoo-ha! Okay, so maybe a Swissy in there. Okay, because if it's going nowhere, at least you're collecting a yield. Now, kitty cat, tie it to oil, right? So we should get into oil. Oil's back down. We're what, 51 bucks? We should take a look at that. Is it hurting our friends in Canada? Very little change here. Big change in price. Okay. So let's very quickly, by the way, I only do COT on Mondays. And then let's also plan out our week, all right? Does that make sense? And then we'll go technically. Usually I just jump into the charts, but on Monday we got to plan things out, right? Do you agree? I mean, that's the right thing to do, right? All right. German CPI. All right. Well, here's the thing. This week, everybody's worried about Eurozone inflation. We've already gotten the data. It's bad. Euro fundamentally should come down, and it's already started coming down. They've missed their numbers, and we're thinking about the ECB meeting, which is what's the ECB meeting? Is it the 22nd? I'm just doing it from my head, right? Do you have all the meetings memorized? I think it's January 22nd, something like that. So, is that when they're going to announce quantitative easing? Or is he going to announce that he's thinking about maybe announcing quantitative easing? That's what's in play here. Okay, guys? That's why was it last week or Friday or Saturday? I don't know. A few days ago, that's when Draghi said, look, we're having trouble with inflation. In fact, deflation might kind of be there, and we're having trouble meeting our mandate. I mean, come on. That's basic fundamentals, right? The central bank in control of the value of the currency thinks they might not even be able to meet their mandate. Like, wow, let's sell that, right? So anyways, so we got this data here out of Germany, fine, but we're already in there. It's already a done deal, right? Some trade balance in Asia, fine. Okay, so you got Asian session tomorrow. Tomorrow's European session. UK PMI, okay, fine. Okay, fine. It could create, small term volatility. ISM services, that can be a good one. Okay, Wednesday, non-farm, ADP, which is non-farm payrolls light. ADP stands for another dumb prediction. Oh, we say that because generally speaking, there hasn't been a correlation between what ADP does and what NFP does. But over the last couple of years, just because we're picking ourselves up from the bottom of the Great Recession, I imagine the correlation's high only because they're both slowly going up, right? But in the past, we have found through crunching years of data, there's been no correlation, positive or negative, with ADP. But I'll tell you what, it's a very good scalp. If you guys want, we can cover how to scalp that someday. That's a good one. So ADP, pay attention to that. What else do you see here for the week? Trade balance can be good out of Canada and the US, particularly because they come out at the same time. IVPMI later. All right. So if you look at that, ADP should move the US dollar. And then Canadian trade balance, IVPMI. So Wednesday is a great day for trading kitty CAD. The next day, FOMC Meeting Minutes. Oy vey. So there's a great late day trade. Okay. Bank of England, central bank event. All right. So the pound's going to move on Thursday. So maybe you do that on Wednesday. You ever think of that? Set up your trade on Tuesday or Wednesday. And then going into the end of the week, Friday, Asia's going to move. Right? Chinese CPI. I mean, what are the big events that move Shanghai? CPI, industrial production, so on and so forth. Right? So that's going to be one. And then boom, we move right into non-farm payrolls. Also, Canada had a horrible result on their Canadian non-farm payrolls last month, right? They're expecting 10, they got negative. Wow. Hoo-ha. All right, so a lot of CAD this week, right? The pound should move pretty good as well. So I'd look at dollar, I'd look at pound, and third choice would be Aussie CAD, right? Like commodities, Aussie CAD. Okay, definitely CAD. Some Aussie, right? And then with Chinese CPI, that's another Aussie trade. So I'd say commodity currencies in general you should watch. US dollar, faux show, and British pound. Those are going to be the big movers based on event-driven strategies. You guys want to move on technically? Yes, Emmett, I'm going to make a recording, make this available to you. For example, it'll be on youtube.com/c/TradersWay. Okay? Hey, Amit, why don't we do this again tomorrow? You want to do this tomorrow? Then let's just meet up tomorrow and we'll do the whole thing over again. But we'll focus on tomorrow's news. Cool. Yeah. Yeah, no, I'll be here. Just swing on by, right? What do you think, King? All right, so very quickly, pound is still losing value big time. Let's start with that, huh? Let me just check. Let's do a market update. Hang on. Where'd my window go? That's not it. Oh, there it is. All right. Well, let's quickly go through the currency pairs again. British pound very weak, euro very weak, Swissy very weak, yen still gaining strength, dollar still gaining strength, Aussie strong, CAD very strong, Kiwi very strong. Wow. Okay, so that's still in play. S&P 500 futures flat, NASI futures flat, 10-year T-note flat at 2.12%. That's not good. Oil down 3% at 51.15. Wow. Hoo-ha. USD yen down 0.25% near 120. Euro USD down almost 1% at 119. CAC is down in France, right? The French stock market's down 0.85. German stock market down 0.5%. UK stock market down 0.75%. So let's start with oil, because that's a doozy, right? Let's try to figure out the trade plan from last week. Oh, hey, it was short at resistance. You're like, really? Yeah, you don't have to be a rocket surgeon, right? Right? Don't have to be a rocket surgeon. What was the trade plan? Sell the retracement up in here, which is, you got the 60 play or the 59 play, right? But the trading in the direction of the prevailing trend with the 3A2 Fibonacci retracement. All right? Pretty straightforward. Things are happening technically. And then look at price action wise. Okay? You test the 3A2. You get a nice drop. So you go ching, right? Then what? Then you get a retracement. It looks like a 786, but it's, it's a micro reversal, right? So you're going to trade it off like a range. Comes down to the bottom of the range, so you're definitely range trading. But the predominant trend, the prevailing trend is down, and you're shorting the 3A2 because you're a bear. As predicted, makes lower high, breaks down because it makes a lower low. Right? You come across and you make previous resistance. Right? Previous resistance, now become, or previous support now becomes resistance. You get your little pullback, and you get your breakout to the downside. Now that we've made a new lower low, previous support will come resistance, and there you are. The other thing you should consider on this trade is psychological levels. Okay, seems to me 50 might be an issue psychologically for oil trader. What do you think? Okay, but so far, basic price action, Fibonacci retracement, extension, all pretty standard. All right, all pretty standard. Nothing crazy going there. What was the trade plan on gold? Okay. All right. We were stinking about it at like 120-ish, went a little higher, right? Remember, it was below 120. Let's see if I can get a little more time in here. All right. That's good. All right. So we broke through the psych level of 120, retraced back to the psych level of 120. If you were a bear, it seems like a very reasonable, predictable place to be ready for a short. All right. I think there's a fib and stuff in there, but let's not make it too complicated. All right. All right. So double tops right at the psych level of 120 and drops like a ton of brick. Not too complicated, right? So where are we now? Well, you know, this is a pretty big retracement. And this was a higher high. So it's a little bothersome for me. Because I'm still bearish. So what do we do now at the weekly central pivot point? Well, I'll tell you what, let's switch gears here. If you're a bull on this, okay, are you at support? Remember, bulls buy at support, bears sell at resistance, right? Okay, I think a bull would really want to buy off the weekly central pivot point with a Stokes kicker like this. Okay, I think it would like that, especially using this as like a 1, 2, 3 type pattern, right? Now a bear is going to trade this like we're top, and it's a psych level. We're pretty close to 120. We've been here before. Okay, it's held in the past. So what would a bear be thinking? Well, a bear doesn't want to sell with an oscillator like that. Nor does he want to sell, or she, at a weekly central pivot point, which very likely could be support. So maybe another test to the top and down is what a bear would be thinking. Or an aggressive bear would probably sell a lower high. Now you want to time this, right? The market is opening right now. Well, not right now. In what is that? 12 minutes. So if you're a gold scalper, you'd be placing your trades right now. If you're an event-driven scalper, you would say to yourself, hey, we're at support. In 12 minutes, the market's open. 15-minute oscillator wants to roll up. So are you at support or are you at resistance? And you might say, well, this is more supportive than resistance. So you might look for like a little pattern here. And maybe you decide to kick it off of the weekly central at the open of the gold market. See, pit trading is just about to start. So you'd want to front run that as a scalper. Does that make sense, everybody? It's just a volatility trade. If you were a bear, you know you need resistance, and I don't see the resistance, not here. If you would have shorted earlier, then fine. But you know, you would need to probably let the market open, because I don't think it'll happen in 12 minutes, and sort of sell it up here. And your trade plan for scalping gold at the open would be to sell it off the top, drop it like it's hot. All right. Are we at resistance now? No. So the only thing I see right this minute, and I mean like dropping into the 1 minute, would be to buy at the weekly central pivot point with price action support, with a 15-minute Stokes kicker at the open of trading for gold, you do one of these thingamabobs. It'd be great if you got a retracement, but who knows, right? And again, if you don't like that, if you're a bear, you know, you need to sell it high. 90, 00, something. Are we good? Next. British pound. Let's just go into the big setup. Do I trade news events? Sure do. All right, let's clean up this chart here. All right. Let's go to British pound here. Now, the disconcerting part of the of this setup is we're already through our pivots. Wow. Which leaves me with less tools than I normally have. But that's how weak it is. We don't even have monthly pivots, guys. But guess what is our resistance today? Okay, that's supposed to be support. That's monthly S2. All right, I don't even use S3, so I don't know where it is. I'd have to, I guess, calculate it. It's pretty unusual to be that low. Okay, what's the top of the month? Monthly central pivot point. So you just observing this is a monthly pivot, okay, and this is a monthly pivot. Does it seem like market participants are using monthly pivot points to you? Even in an extreme month? Even in extreme circumstances? Look how we came back and retraced using that as resistance. And that's the top. Now, the funny thing is, if the top is the central pivot point, the predicted bottom is S2, monthly support 2. We're already through that. So this is, one of two things is happening. A, the British pound is unbelievably weak, just blowing through monthly pivot points, and it's not that late in the month, right? Come on, it's the 5th day of the month. Or last month was a consolidative month, and you know, being December and stuff, that's probably the case. But I'll tell you what, risk is up a little bit now because we don't have the typical tools that we use as trading. That's just more risk. Just be careful. We don't have monthly pivots, so now we're going to have to revert and get new weeklies a lot and try to overlap daily pivot points with weekly pivot points. But the monthly's dead. Okay, I might want to try to calculate, you know, M3, but it's monthly support 3. But that's incredibly rare to have to even use it. Okay, now here's an interesting thing. Here's a tip. You might want to write this down. One of the things I've observed over the many years and hundreds of thousands of hours of trading is that if you hit the weekly targets early in the week, and it's Monday, right? If we come down here, let's say anywhere in the green zone here, you know, anywhere between, you know, we're near it now, like 52, 51.80, let's say, anywhere between 51.80 and 51.20. Okay, in this green zone. If we hit that today, then I have seen many times in the past, just observation, that sometime we will touch the weekly central. I don't know when, oops, right? It could be Friday, it could be Thursday, but I've seen that often, and it's not an always thing, and it's not a guaranteed thing, but I have observed it many times. Again, if you hit your aggressive targets early in the week, I've noticed that many market participants take their profit, and maybe because of it, it slowly works its way back up to the weekly central. Now, what does it do after there? Does it go up or does it continue mission? I don't really know. I mean, that I don't have, but you notice it used to be support. So, you know, maybe it's next Monday we're shorting this thing way up here. I'm not predicting that because the British pound is super weak. It's very, very weak. Very, very weak. Okay. But is it tradable? All right, so let's talk about that. Okay, we're in a prevailing trend, right? We're in a trend. Boom. Okay, comes down hard. That's actually where we closed Friday. And then what happened today? Some pretty bad news, right? Out of the UK. So, how do you trade this, guys? How do you trade situations like this? You sell because it's a bearish trend. So let's say you're trying to trend trade. You want to sell at resistance. And we just made a massive lower low, right? So now you zoom in. I'd like to get that in there a little more. All right. Notice how it reverses at the pivot points. Identify two levels of resistance. One is here, and one is here. Now, the nice thing about at the top, it's a monthly pivot point and a weekly pivot point. Okay? Also, do you guys know how to gap trade? Maybe this is something I can teach you next week, because I'm almost out of time already. Do you guys know how to gap trade? Because there's a gap there. So all I'm saying is there's a couple of things going on. One, you know, it's a breakout, retracement role reversal scenario. So you identify resistance. It's resistance for three reasons. One, monthly pivot points. Two, weekly pivot points. Three, the gap on the open. Okay? Putting those three things together, if you're a bear, it was very, very, very sellable up here around 53. Okay? Now, would you want to sell now? It's unbelievably bearish. I'm looking at the British pound right now. It's the weakest currency pair along with the euro on the planet, right? Well, no, you don't. Well, you shouldn't, not here, because you're a bear if you're shorting, right? So maybe wait for the 5-minute oscillator to come up and sell it like this. The other thing you should be doing is identifying resistance, because you sell at resistance, right? So where's resistance? Well, the only thing you got now, you got the 15-minute 5 EMA. So you can trade it like this, especially with the pivot point. Now, to me, though, the oscillator says it wants to go up for 2 hours. So that puts us to around the 10 a.m. news. So maybe around 10:34, we get something like this. Okay? To me, I'm quite risk averse. So it's fallen like a ton of bricks. I think selling it now is pretty late. But if I'm aggressive, I want to sell it there, probably at the stock market open. Okay, ride the 5 on this. I'd rather you have sold it up high, because I want you to sell at resistance. So there's resistance there. It's tradable, and you want to trade in the direction of the prevailing trend, in my humble opinion. Okay? But the only thing you got is this cluster. It's, I'd call that moderate. Where's the midpoint psych level? 50? Long ways away, right? Where's the next level of resistance? I would call this zone. Okay? Which is about a 618 Fibonacci retracement. Okay, you got midpoint psych level, which is 50 is about here, 52.50. That looks like about what? Eyeballing it, 382. So I think as a bear, what I'd rather see is something like this. Maybe sell it off the 15-minute 21. Plan B, let it go a little higher. Sell it off the 15-minute 55, ideally when the oscillator is overbought and trying to fall. Okay. The other way of trading it is as a bear. You know what I'd like to see? I'd like to see it, or I mean, as a bull, I'd actually like to see it fall a little bit. Pivot points, which is a range trade. You already got the oscillator set up. You just need a price to come down a little bit. But why would you do that? Well, we just discussed it. If you hit the weekly pivot targets early in the week, very often price returns to the weekly central, which is way above us. So a bull might want to put that into play if they're using pivot point theory. There's not much else going on there. That's just pivot point theory. Okay? But a bull that can catch a trade like that, that's what they're thinking. So if price does come down a little more, gets below 52, hits the 51.80, and then you drop into a 1-minute chart or a 5-minute chart and see something like a double bottom or a 1, 2, 3, which are reversal patterns that support with an oscillator oversold, then that would be, and then you jam your stop because it's a higher risk trade, and your aggressive target would be up into here. Your moderate target would be to do the range trade, and the identified range is this is the bottom, this is the top. Okay. The more aggressive trade would be it would come up here, it would come down, it would break, it would retest, and then it'd go up, hit the weekly central. You would have the macro fib, right? The macro fib. I don't know what Elliott wave guys call it, but it's all the same thing. Somebody, right? Some big boy somewhere with a hedge fund and $1 trillion is really just doing that on a higher time frame. I mean, we're analyzing the 1 hour and the 15-minute and the 5-minute. They're using the 4-hour daily and weekly. And all it would be would simply be a 50% retracement. Right? Hey, thank you for attending today. I'm going to put this video up on YouTube. TradersWay is going to share it through syndication. Thank you to TradersWay for hosting, making this available to everybody. I hope you enjoyed it. My name's Wayne McDonald. I'll be here same time, same place tomorrow, 7:30 a.m., which is New York time, which is London lunch. We did a lot of fundamentals today. I do that on Mondays. I like to set up my calendar. I like to know the positions of large traders. And then usually, though, I go right into the technicals and we can review the news of the day. I encourage questions, all that kind of stuff. So, you know, thank you for interacting and all that stuff. I hope you enjoyed it. Everybody have fun today? Everybody enjoy it? Everybody happy? Yeah? Thank you. So thank you, Ron. Thank you, Francis. Thank you, Daniel and Jim and King and Harry and Amit, Michael, Nuno, Ron, and everybody else. Peace on earth. May the pips be with you. May our profits be above average. And I'll see you at TradersWay tomorrow. Awesome.